Hello all, welcome to our single family rental boom is on the horizon webinar. My name is Keith Meisner, Senior Vice President and Co-Head of Investment Sales here at Berkadia. Thank you so much for joining us in what we believe should be a very content-rich program. Our agenda is pretty straightforward. First, we have a great pleasure of having John Burns, Chief Executive Officer of John Burns Real Estate Consulting with us today. John will share his great wisdom. By way of background, John founded John Burns Real Estate Consulting to help business executives make informed decisions. The company's research subscribers received most accurate analysis possible to form their macro investment decisions. And the company's consulting clients received specific property and portfolio investment advice designed to maximize profits. John's team takes great pride in enabling the profitable development of the best places to live in. Following John's remarks, Dory Nolan, Senior Vice President of Berkadia National Client Services, will moderate a Q&A with John Burns, as well as Mark Forrester, one of Berkadia's most active single-family rental investment sales advisors based in Phoenix. Emily Schultz, Managing Director of Agency Lending here at Berkadia, based in Washington, D.C., will contribute to add some commentary to the debt markets as well. Please note that you should be able to submit questions through the Q&A feature in this webinar and at any time. Jory will be aggregating and posting the questions to our distinguished panelists during the question and answer session. Although single-family rentals are not a new asset type, interest from renters and investors alike has gained significant energy over the past several years. Berkadia as a firm has been an early mover in the single-family rental space, starting with more scattered single-site, single-family financing following the GFC. Now, as the sector has expanded and is becoming more diverse and institutional in nature, Berkadia is very active nationwide in selling and financing build-to-rent single-family properties and will continue to advise investors, borrowers, and lenders looking to enter the space in the years to come. I think it's a great time to turn the program over to John Burns. John, we really appreciate you taking the time to be with us today. The floor is yours.
Thank you for that. As usual, I have a lot of information, so if you're going to want a copy of my slides, just email me here at the bottom when we're done, jburns@realestateconsulting.com, and I'll have somebody PDF it and get it over to you. So you gave a good background, so I'm just going to go through this pretty quick, but we're basically the outsourced research department for a lot of the industry. We're just trying to figure out what's going on today to help you solve tomorrow. And I'm going to give you a little background on how we get to these answers. So we do have a very top-down approach. We've got a chief demographer. We're studying the macroeconomics. We put out an almost 400-page report every month on that. We're looking at policy. But we also have a very bottoms-up approach. Our consulting team does more than 600 consulting assignments a year. We have more than 40 active build-for-rent assignments going on right now. And we put out a 70-page report on more than 100 metro areas every single month. And then what I love is I just sit in the middle of all these clients and we get together virtually several times now, but 5 times a year and do a monthly webinar. And we're monitoring a lot of trends too. So this is how I'm pulling it together. And I'm not going to learn anything from listening to myself for the next 40 minutes. So the more questions you've got later, or you want to follow up with me later, or you completely disagree with something that I said, or I'm completely missing something, that'll be my biggest takeaway from today. So we do have research reports that people can subscribe to. And as I mentioned, we do consulting all over the country. So I broke this up into 5 pieces. So why the surge? We'll talk a little bit about that. I'll define the opportunity because you heard him say build for rent. I say build for rent. Someone else, they've got all purpose-built communities. It's all the same thing. But some of them are scattered lots. Some of them are detached homes. Some of them are attached homes. I'm actually working on a fact sheet right now, and I'll share some of that with you. Then I'll explain what I think has already become the challenge. Well, rising demand has pushed up prices, which has caused yields to fall. So that's probably the thing that the Berkadia folks can help you with the most. There are some distinct segments developing. It's not all the same thing. It's not the same tenant. It's not the same expense ratios. And we'll talk a little bit about that. And I think probably a lot of them on the line right now, but there's a new buyer in town too that you're competing with, and I want to talk a little bit about that. So should be pretty packed with information, I hope, and a great use of your time. So why the surge? So I'm just going to do a little bit of the macro overview here because it's super relevant, and I don't think it's really been reported properly. But the government, all 20% of all the essentially cash or deposits in circulation were created out of thin air last year. So there's a lot of cash out there. A lot of it, frankly, is just sitting in people's banks with bank accounts with nowhere to go. And people are looking at their stock portfolio saying, gee, the PD ratio here is higher than it was in 1929. Bonds, I'm not getting any yields. Even junk bonds don't provide much yield. And then also, and I think this is highly relevant, particularly with all investors, is people are concerned about inflation. How do I hedge my portfolio against inflation? And this is a good solution for that. So you ask yourself, what offers a positive yield and an inflation hedge? It's rental housing. I know you're familiar with apartments, but it's a very mature industry. It's it's not as liquid as stocks, but it's highly liquid. This home for rent industry is mature, as Keith said, but not managed by professionals before. Apartments were all mom and pops 40 years ago. Public storage was all mom and pops 20 years ago. I think that's where this industry is right now. It's a maturing industry. The liquidity is improving. I'm not going to spend a lot of time on this, but there's a lot of data and technology that would not have been available 10 years ago that is making this feasible and allowed Invitation Homes and American Homes to Rent, all these huge players, manage portfolio of thousands of homes all over the metro area very efficiently and with the same yields and NOI as apartments. And you can look that up because they're publicly traded. So in an inflationary environment, what happens? Asset values rise because the replacement cost of the house is going up. And I can tell you the replacement cost of the house is going way up because we have a lot of home builder clients. In fact, we surveyed them this month and they told us the year-over-year construction costs on a house have gone up 13%. Lumber's up more than 100, but when you roll the whole thing up, it's all up more than 13%. And if we have inflation and people's wages go up in line with inflation, you should be able to pass rent hikes along because people's incomes are growing. So that's why it's an inflation hedge. This is not just a COVID thing. So we do, as I mentioned, 5 conferences a year, 3 virtual and 2 in person. The one we do every November that we're doing again this November 2nd in New York, this was the theme pre-COVID. This is Bruce Flatt. He manages Brookfield Asset Management. Fortune did an entire issue of a magazine on him. He's talking to all the smart money all around the world. And here's what he said pre-COVID. Institutions can't afford to own fixed income anymore. They literally have no choice. I mean, if you're an institution and you need 7% yield, you can't be buying treasuries. He called this the most important thing that has occurred in the last 15 years for private equity, really. Nothing else compares. And assets that produce cash will go up in value. So this boom we're talking about today has been building for years. We were doing a lot of build for rent studies in 2019. These companies here, these are the scattered landlords, if you will, but they're getting into this too. None of these companies existed 12 years ago. There's 9 of them that own 5,000 plus homes. But you can see the rents vary. Vinebrook, their average renter is down around $1,000. Whereas Invitation Homes, their average renter is more than $2,000. I mean, that's a completely different tenant, right? And then there's another 13 landlord companies that own 500 to 5,000 homes. I'll mention, we have a list of all the major players. We just posted it last week. We did a white paper that the Wall Street Journal picked up on last week called Investor Mania 2.0. There's more than 200 companies with all their infographics on our website if you want to take a look at that. But let's look at what happened over the last year to people that had scattered lot portfolios. So they actually, in an inflationary environment, drove their operating costs down because this is still a new business that is getting more efficient. They raised rents 4% during a pandemic, but a real mix in there of maybe 3 to 4% on existing tenants, and I've seen as high as 9 to 10. Tricon 9 across 20,000 homes on vacant units when they become vacant because they're not jacking the rents on good tenants and they don't want to create a vacancy. But really, if you look at vacancy as what has happened to market rents are up 9. And then if you own this asset all year, the value of the asset went up 12%. And if it's leveraged, which it probably is, your return on equity was even higher than that. I mean, that's a pretty nice inflation hedge and a great return. So the CEO of American Homes for Rent, who owns 50,000 of these, and by the way, his boss, Wayne Hughes, was the one who started public storage, rolling up all the public storages around the country. This was a complete doing it all over again just with houses. He said now that demand is stronger than we've ever seen before. And I know there's a lot of headlines and truth around how strong the for sale housing market is with people moving in, owner occupants. This is rental homes. And so that's why we're seeing the surge. So let's define what we're talking about here. So back up a little bit and just look at the entire country. Every market and submarket is different, but there's 141 million housing units in the country. 129 million of them are occupied households, and actually 12.4 million of them are vacant, which has been rising pretty substantially. And one of the key questions we've got is why there's so much vacancy out there. But 83 million owned, 46 million rented. But let's look at that 46 million. So you're used to big apartment buildings. There's 16 million households in an apartment building, 10 plus units in size. Another 13 million in those 2 to 9 unit apartment buildings. Another 12 million, which is what we're talking about today, in detached rental homes. Another 2.9 million in an attached rental home, like a townhome or a condo owned by an individual. So you probably hear the numbers 12 million, 13 million, 16 million. Sometimes people are adding these together, sometimes they're not. And then there's also mobile homes and boats. But that's the breakout of the rental population in America. So if you just look at those two, and the data, there's multiple surveys in here. They don't all agree. But 15.2 million is our best estimate of the right number. That's 11% of every housing unit, is 12% of households, and it's a third of all renters. I mean, this is a big number. We look at all the vacancy here. There's 2.4 million of vacant homes for rent that you can go rent right now. And you do the math on that, that's 5% rental vacancy, which by historical standards is pretty tight, which I'll have that in a minute. So if 33% of all renters are renting old homes in condos, and this is where all the construction has gone just to the large buildings, why has there been no construction in small buildings? And by the way, a lot of the build for rent communities we're talking about today might be 150 units in size, but the structure is like a 6-unit row home or a 3-unit paired townhome. There's 3 million condos, 12 million old homes, and 2 million other. Why have we not been building anything for the old homes? Why have we completely ignored that? It's because we really didn't know how to do it and manage it efficiently. And so let's talk about this renter profile. I get a lot of questions on this from investors who all tend to be homeowners. They don't, or investing in apartments, and so they don't really understand this person until I explain it, and then they go, oh, okay, well, this makes a lot of sense. This is somebody who, for whatever reason, just wants more bedrooms. They want more privacy. They want a yard for their dog or their kids. They want a garage, and they want their own washer and dryer. I mean, if you don't own your house, you can't get this in an apartment. This is the only way you can get this. I mean, so that's what people are looking for. And then who are they? I'm bucketing a few of them here. I didn't mention we have a huge consumer research team too, who's doing a lot of surveying here, but I'll call them, so there's savers. There's people that, hey, we just got married, we're saving for a down payment, we've got a dog and we got a lot of stuff. We want a house, not an apartment. There's spenders. I mean, there's some people out there that frankly, and there's quite a few who could totally afford to buy a home, but they, rather than save a down payment, they just prefer to spend their earnings. There's a lot of people who frequently move a lot, and especially if you just move to an area, do you want to buy a house right off the bat, or do you want to rent for a while and test it out? We're seeing a rising number of retirees. Now, a lot of the conversation is, do people want to rent or people want to own? I believe there's growth in both. But there's actually a lot of people hitting retirement age saying, hey, the only way I'm going to enjoy retirement is to cash out of my house and use some of that money to live on. So we're actually seeing build for rent retirement communities. And I think I've got a great one in here I'll show you later. And then parents. I mean, if you've got a 10-year-old and a 12-year-old and you're renting, you don't want to be in an apartment complex. They come with a lot of noise and a lot of stuff and a lot of split custody. I mean, that's 12% of America. That's a significant number. Most of them, this is one of the surveys we did, don't come from apartments. 63% of the people that we surveyed here have previously lived in a 17% in a single-family home. 17% of them had owned their home. So they sold their home and moved into a rental situation. People are doing that. And then I know you're very familiar with apartment tenants. And so I want to compare and contrast who's in an apartment with who's in a single family household. And this is something I want to share with a lot of municipalities because they don't completely get it. So the 28 million multifamily households, 16 million single family households when we include the condo. These people in single family homes make on average $10,000 more. They're far more likely to be in that 35 to 64 category, which is a more stable person who doesn't move as often as someone in their 20s, for example. And I think this is the big thing that the apartment guys have missed. I mean, they were very afraid of CapEx, so they're still getting their arms around that. But these are sticky tenants. They don't move. So, and you wonder, how am I going to lease these things up? Well, they don't come vacant very often. And when they do, there's new technologies now. Rently is just one of them, but there's a couple services where people put in their credit card, they tour the empty home by themselves, and then they can sign the lease. I mean, my clients are doing brand new leases without a leasing agent. And then this build for rent or build to rent or whatever you want to call it gets separated into two things. So there's contiguous communities, which we'll talk more about that, and there's scattered homes. The scattered home landlords, the big ones, formed during the downturn, taking advantage of the distress, and that was a great play to buy homes at way below replacement cost, but that opportunity is gone. So they've got a great business, it's making money, it's doing great. How do we grow? They're starting to buy rental homes, and they might buy brand new rental homes too, and there's a company called LGI Homes it's actually the fastest growing home builder and by far the best performing stock this cycle. 10% of every home that they build, they sell to landlords, like 3 or 4 in every community or whatever the number is. It's part of the home builder target buyer profile at this point. And then one thing to think about if you've ever been a renter in a neighbor of homeowners is you don't necessarily get treated very well. You're kind of the deadbeat. And so there's some cultural issues too to want to be with other renters rather than in a homeowner neighborhood. One of the companies who's been leading this charge from the very beginning, very quietly, they don't speak at conferences, they haven't done any promotion, is Redwood out of the Midwest. They've got, I believe at this point, 100 neighborhoods. A lot of them are power townhomes. Here's an example of what it looks like. Everybody in this community is a renter, nice driveway, great house. That's the lifestyle. And if you look at the rental housing construction, single family built for rent is only about 12% of all the homes we've been building. But it's a third of tenants that live that way. So why are we underbuilding this market? And this is why there's such a boom. So let's talk about the rising demand and the falling yields, which the Berkadia folks will really provide some great color on, I'm sure, during Q&A. So this is not brand new. So the purple here is the percentage of households that are renting single family homes. It went from 16% in 2000 to 20% in 2010, and that was the boom and the bust. It was 21% best estimate. This is a 25 to 34-year-olds, so the younger cohort. Let's look at a older cohort, 35 to 44, from 13 to 15 to 17, and then 45 to 54 from 9 to 10 to 13. Every single cohort here, just more and more people have been saying, you know, I would rather rent a single family rental than an apartment. That doesn't mean apartment demand has been waning. That just means that this is taking some share from apartments, but really taking share from home ownership, because these are people that want a garage and a yard and those sorts of things. So this goes all the way back to 1970. This is the percentage occupancy. And this is not great data at the metro level. In fact, it's crappy data at the metro level. But so we've been doing our best to collect as much of this as we've got. I think we've got a great database at this point. But the data is pretty reliable nationally, and that's this. We're at a 95% occupancy on single-family rental homes, which is the highest it's been in 25 years, and that's why rents are growing. So let's talk a little bit about the pandemic here, because it does matter. So this is what was going on in 2019 as of year end. And people forget this, but it was a pretty stable market. And I know a lot of people are running around saying the market's undersupply. We've been underbuilding for years. I don't completely agree with that. I do agree that the last 2 years we've been underbuilding. But prices and rents adjusted for that. And in 2019, home prices were going up 5, apartment rents were going up 4, single family rents were going up 4. Pretty steady Eddie demand, slightly exceeding supply because it's growing faster than incomes. Well, then you look at what happened last year. Home prices shot up to 11, apartments fell to 3, which I know is very submarket specific, and urban was much worse than suburban, but that's what happened nationally. And then single family rents continued to grow, even during a pandemic, with an eviction moratorium and with really kind of a moral obligation to work with people during a pandemic. Rents still grew in 2020 as much as they did in 2019. So here's 3 publicly traded companies that are disclosing all of their information to you. And I think this adds up to more than 150,000 single family rental homes. So Invitation Homes, on a renewal, they're raising rents 4%. They're raising it twice as much on new leases. American Homes for Rent, 4% also on renewals, 7.6 on new leases. Tricon, which plays in a little bit older home, lower rent range, 3% on renewals, but 11% on new leases. And then if you look at the gross rental yields here, this is before the biggest expense, which is property taxes. They vary a lot by market, but the high growth markets where people are looking for yield plus appreciation tend to be down on the bottom here, so your going in gross yield is lower. The markets where most of your return is going to be probably from yield, the Cincinnati and the Indianapolis, the yields are higher. So people say, who are the investors here? The people who are really just looking for yield and I want to own this for 30 years tend to be at the top of this list, and the ones that are part of a private equity fund that need to get out and have some sort of liquidity event in a few years tend to be at the bottom. So, and then the challenge now is that yields are trending down, and they have to be because the entry price is 11% higher than it was a year ago, and the rents are 4% higher. So that's the challenge, and I want to point out too. I wasn't really going to talk about this, but this is also in a world where people are putting a lot of money into Bitcoin and NFTs and all this other, these SPAC companies that 10 years and still have never been profitable. I find I have these conversations a lot with my clients who are experienced real estate investors, and they go, God, this just feels risky to me compared to usual, and they're right. But with everything else that's going on there, frankly, this seems much more logical. So here are some of the segments that are developing. So this is a map of the database that we pulled together with more than 300 communities, and I've color-coded it here by density. And it's very interesting how geographically diverse it is. So the Midwest, those red dots, that's redwood communities with those paired townhomes or single level row homes that are working really well for a really affordable rent. You go down to Phoenix, where I know Mark Stevenson is, a lot of that is what they call horizontal apartments, which is probably a great name from an investor standpoint. It's a horrible name from a consumer standpoint or trying to get something through a city. So we're calling them villas or luxury casitas or those types of things. Some of them are actually pretty small units for a house, but the same size as an apartment. Then you go to Texas, and a lot of it is detached homes. And Florida, there's a mix of this. I think there's two reasons. One is which company is dominating this market and what do they do? So the dominant players in Phoenix tend to do villas. Redwood likes paired townhomes. In Texas, that's the second reason is Texas government officials do not like attached housing and attached rental housing. Everything seems to be, well, they don't like rental housing actually even. But if they're gonna approve it, it's gonna be detached homes. So you're seeing more of that there. And then where are these located? So we have in the top 100 markets in the country, we've gone through with the discipline of grading every submarket. And the discipline is 20% of people live in an A, 20% in a B, 20% in a C, 20% in a D, 20% in an F. So it's no bullshit. We have to actually say 20% of you live in an F market, but F really means more affordable. It doesn't mean well, there is a correlation with more affordable and maybe higher crime and poor school scores. But this is where we're seeing. So these locations tend to be in better locations. A full 54% of them are in A and B markets compared to that's where 40% of people live. I think one of the big misnomers, particularly amongst elected officials at the national level, and because I've been working with some of my clients on trying to better communicate there, is that Wall Street is going into poor neighborhoods and really taking advantage of that type of people. I've actually seen my clients that the median income for Invitation Homes and American Homes for Rent for each of them is more than $100,000. So they tend to be nicer quality homes in higher quality submarkets. That's where Wall Street is mostly putting its capital. And then I mentioned I would talk a little bit about the segmentation here that's developing on density. So these villas are small detached and attached homes. They're rental homes. They're smaller. They're 650 to 1,400 square feet. They're about 12 to the acre. Then you get these townhomes and row homes that are 1 to 7 unit buildings. I should say 2 to 7, 1,300 to 1,750 square feet. So that's somebody who needs a little more square footage. The villas tend to have a lot fewer kids in them, for example. The density there is around 10 to the acre. Then you get traditional detached homes, but they're on the smaller side. They're 14 to 2,000 square feet, about 8 to the acre. I'll mention, I'll have a little bit on this later. In my view, I don't think renters are paying a significant premium for a large yard as much as a homeowner would. So when you've got a property that could be sold or rented, if it's got a small yard, it may yield towards being a better decision to do rental, where if it's got a large yard, it may yield towards doing a better decision to sell it. And then I put this fourth category in here because it's not one we're talking about, but it is the one that the government officials look at, which is the affordable housing. I've heard of some of it described as military barracks style housing. This makes a big difference on when you're trying to go through the approval process. There's particularly one famous case in Georgia right now where the city council is saying we're not going to allow any of this rental community in our neighborhood because they're worried about it being the military style barracks when it's really something that's going to be much nicer. It's actually going to be a detached home community, brand new with amenities. So this is some of the stuff you've seen. I asked a few of our team members to pull together examples. So here's a variety of high density configurations in Colorado, but these are rental homes. And imagine you were going to move to Denver. You wanted to rent for a year to see if you liked it, and there was nothing new on the market. You're going into somebody's old rental home. There is a market for somebody who would rather rent this. And then I mentioned lower densities dominate Texas, but our team in Texas pulled this one together for me. I mean, here's a duplex, 633 square feet, 1 bedroom, 1 bath. And that's not a family household. That's probably a single person who probably is accepting less square footage, but they get a yard for their pet and a barbecue. I mean, less square footage than they would have in an apartment complex. And then this is a trend that just makes all the sense in the world to me that I think is going to explode. So you're all familiar with the fact that people buy second homes and retirement homes in Florida and Arizona and other places. They have to come up with a down payment, own the home. They're only there half the year. Why not come up with a down payment and rent the place and just renew the lease every year? And so here's the Floridian Club of Sarasota. That's exactly that. It's a better financial decision, frankly. And a lot of these communities are offering premium amenities. So in that 300 portfolio of communities I told you, 59% of them have on-site maintenance. So think about that. You're renting a home from somebody and there's a maintenance issue and your landlord is on vacation in Mexico. What happens? Now you've got, well, if you were renting from American Homes for Rent, Invitation Homes, or Tricon, you'd have a 24/7 call center where somebody would service you. That's one of the reasons why they're doing so great. How about having the maintenance guy just down the street, because this is a 200-unit community and they've got a full-time leasing person and a full-time maintenance, a pool, walking trails, dog park, spa, etc. And then, and I want to do some more work on this because I think there's some truth to this, but I think it is being a little bit overstated. But some of these companies are building these homes to own for a very long time, particularly these REITs. That's their strategy because they don't flip homes. They're actually putting higher quality materials into the house, and it's newer materials too. So if you're the tenant, you're like, wow, this stainless steel appliances, a walk-in closet, master bedroom, 9-foot ceilings versus that single family rental home that's 30 years old with an 8-foot ceiling. This is just so much nicer. And then we do have, for our research clients, we have a lot of the metro level data in dashboards that you can sort. I just did one screenshot in here because I wanted to share it with you. Look at the rent growth on the rent index that we have in some of these markets. So Phoenix, Riverside, and Tucson, rents are up more than 10%. 10% during a pandemic when everybody wants to be a homeowner, supposedly. And you can see the numbers down there all the way. I sorted it by this. But then if you look over at the right here, this is how much home prices have gone up. Rents are up 10, home prices up 20. I think they've been doing pretty darn well in Phoenix. So let's wrap this up with the new buyer in town, and then we'll go to Q&A. So many home builders now consider build for rent an important part of their business. It's funny, you know, when I started talking to them about this, in fact, I was just reminiscing with the CEO of Invitation Homes. He got up at our conference, I think it was in 2013, and was talking about what he was doing, and people said, that's ridiculous. And then 3 years, you know, now he's got an 80,000 home, I think $18 billion market cap company. A couple years ago, a couple of our clients, BB Living was one of them, got up and said, we're going to build rental communities. And all the home builders were like, why in the world would you do that? Now it is a critical part of their business for a lot of them. Even though they can sell everything they're building, they're also realizing, hey, if mortgage rates go up 4.5%, this could be a real lifesaver for me. If all of a sudden people start buying, and I know that people will rent. And it's not just about the economy either, which I'll talk a little bit about the cyclicality of apartments versus single family rent. Well, I'll hit it now. So the apartment industry, as you all know, is very cyclical, primarily because when a recession hits, it also tends to be correlated with a lot of construction coming to market, and then all of a sudden you've got demand going down and 300,000 new apartments come into market, which that's how much is getting finished this year. Single family rental, they've been building single family homes for sale, but the supply here is really low. So historically, it's been a much less cyclical business, and I could show you, I think rents have never fallen nationally. I think that is going to change as we start to get a lot of construction. But here's some quotes from a few publicly traded home builders. So Taylor Morrison, which is partnered up with a company called Christopher Todd, saying we now have build to rent in 9 of our 21 markets, and I think they're going to all 21. D.R. Horton did something that has got just a ton of notoriety. They built a 124 unit community in Houston sold it, I think it was in December, for $32 million and booked a $14 million profit on that. And then LGI, I mentioned, they call it their wholesale business. It's 11% of all their closings are going to landlords. And then you probably saw the headline last month. Lennar partnered up with, led by one of our clients, and started a new venture called Upward America, $4 billion of capital for people who want to live in brand new homes at an attainable price point, all without putting up a down payment, which is everything I showed you earlier. So I want to do a little bit of the math here on the buy versus rent, just so you can, or build versus rent, build and sell it versus build and rent it. So I asked my team who does a lot of our valuation work to come up with a typical community in Phoenix. And this is a couple months old, so the numbers are probably more expensive. But looked at one where it would be a 1,700 square foot homes, 144 units, selling at $6 a month. This is how a builder would look at it. The finished lot's 110 grand. I'll price it at 360. Cost me 175 to build, 10 to finance. $31,000 profit margin, 9%. Or I can take those and lease them up, and leasing generally goes quite a bit faster here. The construction is, well, right now everything's just going gangbusters. But in 2019, what you could do with a trade is you could look a trade in the eye and say, I've got 144 units here. I can keep your entire crew busy for 2 years. None of this like sales have slowed. I don't want you coming to work on Monday. And you were getting good pricing for doing that. The average rent would be $2,200, same lot cost, a little bit more expensive on the home with the nicer materials, financing, everything else, but no sales commissions. The gross yield would be about 8% on something like this. So that's the trade-off. Now here's the new buyer. So I hid the name on this because I didn't want to look like I was propping somebody up, but I heard about this. They're actually a client of ours, so I just put 10 grand in to see what was look like. They took my 10 grand in 5 minutes and put me into this portfolio of rental properties. This portfolio included that D.R. Horton community. So this isn't just about big investors like yourself. These are people that are trading GameStop that you can go down to $1,000 apparently, and own part of a home. Roofstock has Roofstock One now, where you can own part of a home. In fact, why take market risk on 10 homes in Phoenix? Why not just own 2% of a portfolio of 1,000 homes, which is what this is. This is the community in Houston that was in that portfolio. This is what they're saying on their website. It's going to be a 3.6 to 9% return. It's got beautiful video, including a drone tour. Here's another one, promising a 9% preferred return yield on it's close to 192 brand new homes. Here's where the homes are located. $53 million of homes. That's $274,000 a house. They were all built by 4 home builders, but they're scattered in communities, 47 communities all over the country, so all over the state of Florida, so a little more diversified. And then this has been the game changer. So I'll talk about my friends at CalSTRS here for a minute, but I was discussing this with them years ago, and they said, this is the real estate group. They have entrepreneurial capital groups too, but the real estate group says, we're not going into this until it's a proven business. They answered. So CalSTRS partnered up with PCCP and has announced a $1 billion build for rent future fund. $240 million already invested. They're looking for local operating partners. Let's go back to what Bruce Flatt said. Institutional capital has no choice but to get into this type of stuff, and institutional capital is in, which is going to make it permanently more expensive. So the 4 main takeaways here are there's a plenty of opportunity to build. I'm sorry, my graphics got cut off there. The yields are falling. If you're going to get into this, location-specific segmentation is going to matter. The person renting that 600 square foot 1 bedroom, 1 bath is different than somebody renting a detached home. And so like the local jobs and other things are going to make a difference. And then yield hungry investors, including institutional capital, are driving up prices. So with that, I am going to kill the screen share and we'll go to Q&A. But if you want copies of this, just send me an email.
Great. Thank you very much, John. Thank you for preparing such a comprehensive presentation on the single-family rental sector. Your research, keen understanding of the asset class, and ability to present the subject matter in such a persuasive manner is much appreciated. So thank you. So let's pivot to the Q&A. I will actually start with you, Mark Forster. What types of investors appear to be the most active in the single-family rental space? Private capital, institutional, life companies, or some other type of investor?
Dory, thank you for that. In Arizona, where we've done most of our work, it began with private investors, but as John mentioned, we have many more institutional investors either coming into the space or dedicating people in their shop to fully understand the space, and they will be coming in. But up until now, and it was partially due to interest rates and cap rates, the private investor up until now oftentimes has outcompeted in price the institutional investor, but I think that will change as we go forward.
Okay, great. Thank you. Emily, the next question is for you. What is the availability of financing for single-family rentals, build for rent transactions, and also is Berkadia actively financing these types of assets?
Thank you, Dory. Thank you for having me. And thank you, John. That was incredible information. Dory, I'm glad that you differentiated between the single family rentals and the build for rentals because debt options are very different depending upon which product you have. And I'll start with the single family rentals, which, as John mentioned, are those scattered non-contiguous deals. The agencies, meaning Fannie and Freddie, they actually did have a single family rental pilot program that began kind of in 2015. Ramped up through 2017, and then FHFA shut it down. So at this point, the agencies aren't really going to play in that scattered site space unless each of the buildings has 5 units or more. This really sort of kicks out most deals in that category. So with the single family rentals, you've got a handful of debt funds that will quote, and we're talking about those fractured condo deals or you know the multiple scattered site parcels. But I think they're going to need to see some volume even within those parcels. I reached into the head of our debt funds, and he said they're not really doing those onesie twosies kind of deals. But yeah, debt sources for this product, they're really still trying to get their arms around what it is. So my advice there is just reach into Berkadia's mortgage banking team. They are super highly communicative. They're incredible at sharing information up to the minute. So this is sort of an evolving debt process, and the options are evolving. So that's my advice there. Once you get into the build for rent side, your options really open up. So this is the true multifamily, single family communities. Life cos and debt funds are quoting. And I really want to mention there has been quite a bit of movement in the agency space. So just 4 months ago, Fannie Mae made some changes to their guide that really provided a lot of clarity in this space. So essentially, if you've got a property that was originally constructed to be a multifamily development and Fannie Mae is financing the whole thing, they're looking at it as just a regular conventional deal. So that means in terms of structuring, in terms of pricing, it's the same. So if the property supports it, leverage can go up to 80% on an acquisition. And I think Freddie Mac is approaching it in a similar way. We've seen Fannie Mae get a little bit more aggressive, but to answer your second piece, yes, Berkadia is actively financing these. We're doing bridge, we're doing perm. So reach in.
Wonderful. Thank you very much. That's really helpful to know. And as Emily mentioned, please reach out to Berkadia Mortgage Banking should you have any questions with respect to financing single family rentals or built for rental properties. John, I'm going to direct the next question to you. As we're seeing so many new investors betting on single family rentals and built for rentals, is this a permanent and structural shift just given the onset of the pandemic, or is this more of a short-lived phenomenon and we'll see things change once some of the other asset classes return to a more normal situation?
Well, I think it's a bit of both. There's no doubt in my mind this is permanent. I mean, the publicly traded REITs have proven this works. I think a lot of the capital that is rotated in, though, as I alluded to, just doesn't know where else to go. And particularly a lot of real estate capital that may have done office buildings or retail or hotel, just no opportunities. So I can see some of the capital that is flooding in maybe moving elsewhere as things change. And I'm most curious as to what's going to happen when the yields get ridiculously low here if this price appreciation continues. But that being said, for long-term owners, this is permanent and this makes a lot of sense.
Okay, great. Mark, I'm going to direct the next question to you. How do cap rates compare to built for rent versus multifamily cap rates, especially in Phoenix on the transactions that you're recently working on?
Dory, we've seen basically no difference in cap rates between a traditional Class A multifamily property on the market and a single family or built for rent community. And in Phoenix today, that means cap rates are plus or minus 4% most of the time. But the values, like John said, are higher because the rents are higher and the operating expenses tend to be a bit lower. And you apply the same cap rate, and there's a significant delta in value, oftentimes between a single family for rent and a traditional new sale.
Okay, thank you. John, I'm going to direct the next question to you. How are demographic trends driving single family rentals and built for rental interests? And this is from the renter demand side. And how has COVID played a role?
The COVID one's going to be easier. So that we actually did a book on housing demographics. It's called Big Shifts Ahead 4 years ago. There was a belief that people didn't want to own homes as much, particularly the millennials. Now we're learning that they're just getting it later because they're getting married and having kids later. I think the biggest demographic shift is what I showed earlier with the being able to rent a retirement home or a second home before you retire in Florida. So I think that's one. The big COVID shift, and I've got the math on this because we've done a lot of surveying on it, is the permission slip to work from home, even in a hybrid environment. And Coldwell Banker put out a really interesting survey yesterday. I saw one of my clients, Ryan Gorman, on CNBC talking about it. People are going to move because they don't have to come into work every day. And that is allowing people to live where there's more land. So you're going to see the construction was partially constrained because all the job growth had been in urban areas. But now that if you can live 2 hours away and only come in 1 or 2 days a week or a month, it's going to open up, it's going to solve the affordability problem for a lot of people who were renting because I needed to stay close to work. Now I can become a homeowner for the same monthly payment. I just have to do it an hour away. And then what's most interesting to me is we've seen a shift towards the south that was already going on. It is accelerating, and I think you're going to see the big growth markets grow even faster because of the work from home permission that came out of COVID.
Okay, great. John, we're going to stick with you because there's just a follow-on question. You mentioned earlier in the presentation that the typical profile of the renter living in a built for rent or single family rental property was, the saver, the spender, the retiree, somebody looking for mobility. How does that truly differ from the traditional apartment renter? Is it truly a different profile, or are there similarities that we should be mindful of?
Yeah, well, they're far more likely to have kids. I mean, because you want more space. You're far more likely to be a little bit older because as you get older, you got a lot of stuff, and you just where are you going to put all your stuff? There are a lot of shared custody couples, but the difference is more lifestyle choice. I'm somebody who wants to live in a home with all the stuff I can get in a home versus somebody who wants to live in an apartment, which is a little more low maintenance. It's just a different choice, different person.
Okay, great. Mark, I'm going to direct the next question to you. Can investors build diversified portfolios by owning single family rentals and built for rental properties and portfolios?
Absolutely, and I think you're beginning to see that. This space has become so interesting to so many different types of developers and investors that I think you'll see a continuation of that. We're actually working on a deal now, a new development deal that will have it's about a 20-acre site. It'll be a combination of traditional apartments, and they'll have a separate section of this operated out of the same clubhouse for a single family for rent. I think you'll see more and more of this, especially as land prices go up, and the traditional single family for rent developer may have to incorporate some more density into the project in order to compete with other people trying to buy that site.
Okay, great. Mark, I'm actually going to stay with you for a minute. Do single family rentals and built for rental properties have the same level of liquidity characteristics that multifamily properties offer?
I see no difference whatsoever. I mean, they're very liquid investments. The only difference is that especially on the private side, people that have bought these properties tend to want to own them longer. So the liquidity for the buyer trying to buy something that's already been sold, that sometimes can be more difficult. You know, a lot of the private guys have put these into family trust and other types of longer term vehicles, and they plan on owning these for quite a while.
Okay, great. John, I'm going to turn it back to you. I mean, you spent a lot of time talking about the profile of the renter. Have you done research where you've been able to measure the average life of the lease that this renter has stayed at a property? Is there,
Yeah. It's about 3 years, and this is relatively new. But if you look at any of the publicly traded apartment companies, they get about 70% turnover every year, and these guys are getting about 25. So people are staying put. You know, I had a question for Mark, if I could ask, and are there a lot of depreciation of benefits associated with this too, that some of these family trusts love?
Oh, absolutely, John. I mean, a lot of these private buyers, they may have over the years owned different types of multifamily, and their depreciation has typically run out. And while they're setting things up for the next generation, depreciation on buying the new property is certainly an important element of their decision. Yes.
That's what I'd heard. Okay, thank you.
John, one more question for you. What are some of the challenges in developing and operating and managing single family rental properties opposed to a standard multifamily asset?
Well, one of the challenges on buying into this is the comps, and that's what I hear a lot from the apartment guys who are now studying this hard, going, why am I not doing this? It's just we don't understand this. We can't look down the street and see 10 apartments that are exactly identical and know exactly what the rents are going to be. So there's some more risk going in. The other risk I hear all the time is CapEx. There's a lot of roof on every single one of these units, and if there's a roof leak, that's really expensive. The HVAC is expensive. But these are all the issues that big single-family rental landlords have been dealing with and figuring out. And then leasing, there's a mindset shift here that you need to overcome, which is that you don't need your leasing agent to be walking people through all these units. Trying to lease these things all over the place is ridiculous. They have these apps now where I could go up, register in 1 minute, put in my credit card, get inside the house, take a look at it. They know who I am if I do any damage. They've got cameras inside if they want, and then frankly come out, and then they'll send me a lease agreement, and these guys are selling leases that way. And then on the maintenance, the sophisticated ones are saying, well, you've got a problem, your garage door is stuck. Well, let's get on FaceTime and you can show it to me, and maybe I can teach you how to fix it yourself instead of having to send out a tech. So the guys are just being really smart and using technology, and I think that's a lot of what people are missing.
Okay, great. Okay, well, let's wrap things up with the final question, and I'll let you start, John. Where do you see the single family rental and built for rental space in 5 years?
Yeah, well, I think it's going to mature and become much more like the apartment space over the next 20 to 30 years. It's going to take a long time to get there because most rental homes in the country, I think more than 80% of them are owned by somebody who only owns 1 or 2 properties. And as Mark said, they have no interest in selling. So I think 5 years from now, it'll probably, well, well, let me go to build for rent. So we're releasing a podcast this week with Greg Vogel, who's the CEO of Land Advisors, the largest land brokerage in the company. He sees in his business about 20% of the activity is going to build for rent. So he thinks long term, 20% of the single family construction in this country is going to be single family rental homes. So I think that tells you where this is heading.
Okay, wonderful. Mark, where do you see the single family rental and built for rent space in 5 years?
I completely agree with John. I mean, it's a permanent part of our business now. This is not a temporary COVID-related issue. It was doing fantastically well pre-COVID. You're going to see this as a very integral element of multifamily, just like senior housing is, just like student housing is. This is a very viable niche of the market, not for everybody, but for an increasingly growing part of our population, in my opinion.
Okay, great. Emily, where do you see single family rent?
From the debt side, I think, on the built for rent, it's there. I think there's a lot of demand. On the single family, I think with more of a track record of operations, being able to see how income and expenses track out. John mentioned the repair and maintenance and the CapEx expenses being higher, but is that offset by sticky tenancy and the lower turnover expenses? So I think once debt providers can get their arms around that, and then once there's more available stock to be able to really confidently value, they'll feel some comfort, and I think those debt options will solidify. And then if you add 10 more years, I'm going to live in one. I'll retire and live in one.
Okay, great. Well, that concludes the Q&A segment of today's webinar. Thank you, John, Emily, and Mark for your insights to the questions submitted. With that, we'll bring our discussion to an end. Above all, a final thank you to everyone who joined us on today's webinar. We hope you found the material informative. As a reminder, a recording of this webinar will be available shortly. As always, please don't hesitate to reach out to anyone at Berkadia with questions or follow-up. He or she will direct you to the right resource, get you the answers and insights you are seeking. We are here for you. Thank you again and have a great day.